Welcome back to JPX Energy Market Weekly Updates. Crude oil futures last week reversed most of the previous week's sharp gains as negative indicators including demand downgrades, high U.S. inflation figures, and a firmer dollar canceled out the price rebound, which came on concerns over a squeeze on European diesel supplies. Oil prices Monday were cautiously higher as markets found support on expectations that China would take measures to boost economic growth, but market sentiment still remained fragile. Front-month Dubai cash for December delivery on Monday was assessed at $89.66 a barrel versus the $94.35 a barrel the week ending October the 7th. The prompt market structure also softened despite the OPEC Plus cuts kicking in from November, with the first line and third line spread seized back by nearly $1 a barrel to below $5 a barrel. According to the IMF's World Economic Outlook, global economic growth is forecast to slow from 6% in 2021 to 3.2% in 2022 and 2.7% next year. This is the weakest growth profile since 2001, except for the global financial crisis and the acute phase of the COVID pandemic. Accordingly, world oil demand growth in 2022 and 2023 is revised down by the IEA, EIA, and OPEC to reflect recent observed economic trends and developments in various regions, according to the newly released oil market report. The IEA has revised down its global oil demand growth by 60,000 barrels per day for 2022 and a sharper 470,000 barrels per day next year. The biggest downgrade comes from China, where ongoing government restrictions to stem the spread of the coronavirus pandemic are impacting mobility and economic growth. Demand has been revised lower for the second half of 2022 and the first half of 2023 by an average of 460,000 barrels per day, on expectations that these severe policies will be more protracted than projected previously. However, an anticipated gradual rebound in Chinese activity is also the largest single element in 2023 oil use gains, contributing 810,000 barrels per day of the 1.7 million barrels per day total. Before domestic demand for refined oil product recovers, feedstock imports by China's independent refiners are set to rebound in the fourth quarter following China's move to hand out 2023 crude import quotas much in advance, bucking the negative trend seen in September when imports dropped close to 6% from a month earlier amid ongoing tax investigations. The OPEC have also lowered the demand growth forecast for both this year and next year. For next year, growth forecasts were lowered by around 360,000 barrels per day to lead demand growth at 2.34 million barrels per day. The OPEC also see demand for their crude at 29.45 million barrels per day, which is below September production levels of around 29.8 million barrels per day. However, if we see effective cuts from OPEC a little over 1 million barrels per day through 2023, this should mean that global oil inventories should continue to decline next year. Oil prices also came under pressure on growing expectations of further sharp rate hikes. This has also been a major driver of recent market volatility. The CPI in the United States eased for 33 months to 8.2% year-on-year in September, but still a little above market expectations of 8.1%. And besides, the annual rate remain well above the U.S. Federal Reserve target of 2%, suggesting policymakers will maintain their hawkish rhetoric and keep raising interest rates at a quicker pace. For countries using other currencies, including many of the globe's emerging markets, the strengthening U.S. dollar makes it more expensive to convert local currency into the U.S. dollars necessary to import crude oil. In the past few years, the price of crude oil has often but not always moved in the same direction as the value of the Standard & Poor's 500. When demand-side factors dominate the market, the price of crude oil usually keeps a positive relationship with equity prices as economic conditions were reflected in the profitability of companies as well as demand for oil. This is observed from the second half of 2020 through 2021 and similarly from July to now. On the oil product market, European diesel cracks has been pushed higher by refinery maintenance across Europe, French strikes, and a move away from Russia's supply ahead of next year's ban. Refineries in Japan, South Korea, Singapore, and India are all due to go into maintenance over the next 6 weeks. Slowing output and rising domestic demand caused U.S. distillate stocks to drop to levels last seen in 2008, meaning the regional supply is likely to fall until additional export quotas from China kick in, expected from December onwards in a meaningful way. Refiners has been incentivized to import high-yielding middle distillate-rich grades because soaring diesel cracks. So this should have supported the diesel-rich grades such as Brent, while the value of Dubai and similar Middle East crude would be driven down by their fuel oil cut. However, with Chinese demand returning and the capacity tightening in the Middle East, it's not surprising to see the benchmark Dubai is priced higher against Brent next year. Okay, that's all we have for this week. Welcome back next week.